What is going on, everyone? Hope y'all are doing well, and in this video I'm going to talk about a new company that I just started investing in, and I'm really excited to bring this one to you because I don't think many people even know this company exists, never mind the fact that they are undervalued in my opinion. But hey, you want to know what else is undervalued? That like button. So if you don't mind, hit that like button down below. That helps this channel a lot, and with all that said, let's go ahead and dive right in. Alright, so the company we're going to be looking at today is in the used car space, and that stock is Shift Technologies. Just kidding. But it is in the used car space, but not for selling used cars. This company is called Carparts.com, and it is a company that doesn't use brick and mortar to sell their products, but does everything online. They sell all sorts of auto parts for car repair, maintenance, collision, and accessories for competitive prices, and that is only the start for this company. First, when we look at the industry, they do have some solid competitors like AutoZone and O'Reilly. There's still plenty of space in the auto parts sector for these companies to thrive. The total addressable market, or TAM, for Carparts.com is about $300 billion, and they are less than 1% of that amount. However, when we look at these companies, there is a significant difference between them, and that is their physical locations. Especially after Amazon, we've come to figure out that companies don't need to have physical locations to sell their products. And when you think about it, if something goes wrong with the car, you may not be able to actually drive it to the location to get the part that you need. Given the current times, there is going to be a change in consumer spending, especially if we are in a recession or are going into one. But the reality is that no matter the current financial situation, cars will continue to need repairs, and I think this protects them from anything that could happen within the economy. Because even though there were stimulus checks to get auto repairs last year, they're still able to see double-digit growth for this year. The people within the company are geniuses in the way that they have orchestrated this whole thing. First, not having physical locations allows the company to have lower expenses because of less workers that they need to pay and facilities that they need to keep up, which ends up reducing supply chain costs. Second, their strategy allows them to send parts directly to consumers, and this could work for an auto repair shop or to individuals working on their vehicles. Third, their warehouses are in prime locations, so they will be able to send their parts in a couple of days. And what has all this resulted in? The company generated $166 million in revenue this past quarter and had gross margins of almost 37%. They also had a positive net income and said that they are continuing to focus on profitable growth. So for a company that has a market cap of $425 million and is looking to have over $600 million in revenue for the year, with profitability on the horizon, there are definitely plenty of things I love about this company. Profitable growth is extremely important, especially in the financial times we're in. And I believe that the approach this management team has put into place will benefit the shareholders in the end. They have 4 key focuses, and even though these sound like simple terms, the order of them, I believe, is most important. The first of these is on customer satisfaction. Even though many shareholders want them to be the focus, I've learned that when customers are satisfied, many times the shareholders benefit later with a good management team. The second focus is on operational excellence. Efficiency will always lead to better margins, and we have seen this over the past couple of years from this company. They have put themselves in a position where they are now able to send their products to multiple warehouses across the US to then send to the customers in a short amount of time, reducing the amount of expenses for transportation. And I think this is only a small piece of how they are able to continue to operate on a high level. And speaking of warehouses, they are building a brand new facility in Jacksonville, Florida, which is scheduled to be operational in the latter part of Q2. And once this facility is operational, the company expects 55% of the customers to receive their parts in 1 day, and 98% of them will receive it in 2 days' time. The third focus for this company is financial discipline. The times that we are in require greater focus on cash distribution, and so how the company uses the cash that they do have is extremely important right now. But the one thing they have going for them is their do it for me space. I'm excited about this because they will work with other repair shops to get the right parts sent to the best place for the lowest price. I mean, think about it this way. The company is basically the middleman to send their most competitive priced products to the best overall repair shops. They don't need to pay for the mechanics, so that's less expenses for them. And they get to grow their brand awareness with the shops that they are working with. And that leads to the last focus, which is innovation. In order to grow their total addressable market and get repeat customers, they need to be able to build more connections with the stores that work with their current customers. The Do It For Me initiative will do just that, not only sending new parts to customers, but connecting customers with their auto repair clients. This is definitely going to be one of the most important things I'll pay attention to toward the end of this year. It is from projects like these where I believe an acceleration in their revenue will come from. When we look at the kinds of growth that this company is experiencing, I think the most important thing to see is that their gross profits grew 24% year over year. Now, of course, this can change in the next quarter, but to see that their growth actually outpaces their own revenue is a nice thing to see because their profitability isn't totally dependent on the amount of parts that they sell. Another thing I think is important to note is the stickiness of the business model. As long as the company has competitive prices, they will grow. And over this past quarter, over a third of their sales came from repeat customers. One thing, however, I would like to note as a caution flag is the amount of cash that they have on their balance sheet. Currently, they have about $25 million and $5 million in revolver debt. Now, they do have another $6 million in receivables, but this is still a lower amount of cash compared to other companies. But I do not see this as a big issue, especially because their inventory is already purchased for this upcoming quarter. Turning to the management team, they are new. But if this is a company you are looking into, I would encourage you to listen to their conference call because they definitely know what they're talking about. Honestly, I was shocked to hear how strong their responses were given their new promotions in the past couple of months. But this company looks like they have a strong game plan to execute on expanding their overall business. Now, this may seem like a boring brand or idea, but sometimes the most boring brands and ideas perform really well in the stock market. I think one of their peers is actually a really good example of this. AutoZone is not one of those companies that you will just look at and say,
man, I really wish I owned shares of this company.
But over the past 5 years, this stock price has done extremely well. And I see a similar thing happening with Carparts. Do I see a massive run up in a short amount of time? No. And honestly, I don't want that from this company because I know over time the profits will continue to grow. And as long as they continue to grow revenues double digits for the next 5 years, I will make some great returns on this one. So I started buying this one in the 6s and I will continue to buy in the 8s. I don't mind slowly building my position on this one because if it runs up quick, then great. I can buy some other companies, especially given the fact that there are some large caps that are starting to hit prices that I would like to start buying. So taking my time to build this position is perfectly fine with me. But hey, I would love to hear your thoughts on this company, so feel free to leave them in the comments down below. If you enjoyed this video and want to hear more content like this, hit that subscribe button down below and notification bell. That way you're notified when new content comes out. Hope you all enjoy the rest of your week and we'll see you in the next one.